Have you ever looked at a trading chart, maybe thinking about, scalping or short-term moves, and just felt completely overwhelmed?
Oh,
It's
yeah.
just this visual overload sometimes,
Yeah.
right? Like a tangled mess of lines, indicators.
It looks really complicated, and it's totally understandable why a lot of beginners just, well, shy away from that kind of thing.
Exactly. It
Oh,
feels like you need a PhD just to figure out where to start.
it's a very common hurdle.
Yeah.
That feeling of information overload is a big barrier. And often it comes from thinking you need this super complex system, maybe loads of indicators, to find an edge, especially in short-term trading where you need clarity, quick decisions.
Right. And that's exactly what we want to tackle in this deep dive. We're looking at insights from just one source, actually, a video transcript. And it makes a pretty compelling case for, well, simplicity.
Mm-hmm.
It lays out this really straightforward trading strategy, cuts through all that noise by focusing on just one specific indicator, combined with, basic price action around a key level.
Yeah, the mission here is really to pull out the core ideas from this source and show you how maybe a more minimalist approach could be, well, pretty powerful for spotting potential trade entries without getting totally lost in all that chart clutter.
Okay, so let's dive into this simplicity solution that the source is pushing. They kick off by highlighting that exact problem we mentioned. Charts just drowning in indicators.
Yeah, layers upon layers sometimes.
It feels like you have to track 10 different things all at once.
And the source argues that this complexity, I mean, while you might think it gives you extra confirmation, it can actually distract you from the most critical thing in short-term trading.
Which is,
The raw price action itself. What are buyers and sellers actually doing? When you're looking at all those lines, it sometimes gets harder to just see the basic supply and demand playing out at key spots.
so their alternative is, well, pretty radical simplicity.
Yeah, basically, clear the chart, focus on one core concept, one indicator.
And that single indicator they've picked for this strategy is the volume-weighted average price, VWAP.
VWAP, that's the one.
VWAP. Okay, let's break that down a bit. What exactly is VWAP and why single this one out?
Okay, so VWAP, it represents the average price of an asset over a specific period, like a trading session. But the crucial part is it's weighted by volume.
Weighted by volume,
Yeah,
unlike a simple moving average, right?
exactly. With a simple moving average, every price point just gets the same weight in the calculation. But VWAP gives more significance, more importance to the prices where higher trading volume actually occurred.
Ah, okay. So it's not just an average price. It's reflecting where the bulk of the trading happened, like where the real money was moving.
Precisely. That's a good way to put it. It makes VWAP arguably a more dynamic and representative benchmark for the true average price during that session. It reflects where most participants were actually agreeing on value, by transacting.
Interesting. Now, the standard VWAP on most charting platforms,
Hmm.
it usually comes with more stuff, doesn't it? Like bands and fills.
Yeah, that's typical. You'll often see an upper band, a lower band, maybe a shaded area between them. But the source's recommendation specifically for this strategy is to just strip all that away.
Really. Just the main line.
Exactly. Get rid of the upper band, lower band, the band fills. The whole idea is to get a really clean chart where your only focus is the relationship between the current price action and that single VWAP line. Nothing else cluttering the view.
Okay, super clean chart, just the main VWAP line. Now, the source mentioned something about an anchor period setting. They used session for the 5-minute chart examples. What does session actually mean, especially for something like crypto that trades 24/7?
Right, good question. So for assets that trade continuously, like a lot of cryptos, session typically just means it resets every 24 hours. So if you set the anchor period to session, the VWAP calculation covers the current 24-hour trading period. It gives you a daily volume-weighted average price level to watch.
Got it, a daily anchor. Makes sense. The source also threw in a note about checking a larger time frame, like maybe the 30-minute or 1-hour chart, even if you're trading on the 5-minute. Why bother with that?
Yeah, that's about context. It's basically about identifying the overall trend.
The bigger picture.
Exactly. The source suggests that if you can confirm the direction on the higher time frame, like is the 1-hour chart generally trending up or down, and then you only take signals on your 5-minute chart that align with that bigger trend, well, that can potentially increase your probability of success.
So you're trying to trade with the larger flow, not swim against the current.
Pretty much, yeah.
Yeah.
It's like checking the tide before you start paddling, like you said earlier.
Okay, that makes sense. So we've got our clean chart, just the single VWAP line. Maybe we've glanced at the higher time frame trend. What are the specific price action things we're looking for around that VWAP line?
Right, so the strategy really zooms in on some fundamental price action patterns. These are things that can happen at any key level, really. But here, VWAP becomes the specific benchmark where these patterns become potential trade signals for this approach. The source highlights two main categories, bounce reject and then break retest.
Okay, let's start with the bounce scenario. What does that look like?
Okay, so imagine the price is trading above the VWAP line. That suggests, a generally bullish bias on this particular time frame. Then the price comes down, it touches the VWAP line, but then it turns around and moves back up away from the VWAP. That's what they call a bounce.
And what's the thinking behind that? What does that bounce off VWAP tell you?
Well, because price was already above VWAP, the bounce suggests that when it came back to test this important volume-weighted average level, buyers stepped in, they defended it, prevented a break below.
Oh, okay.
So it implies that the underlying buying pressure is still there and the upward momentum is, likely to continue. Your immediate view should probably remain bullish.
And I guess the reject is just the mirror image.
Exactly the inverse, yeah. So price is trading below the VWAP line, suggesting a bearish bias. It then rallies up, touches the VWAP line from underneath, but then it turns around and moves back down. That's a reject.
So selling pressure came in at VWAP.
Right. It shows that when price reached that VWAP level from below, sellers stepped in, they stopped it from breaking above. It suggests the downward momentum is likely still in play, and your view should probably remain bearish.
So in these scenarios, VWAP is acting kind of like dynamic support when price is above it and bounces, and dynamic resistance when price is below it and gets rejected.
Precisely. And it's the price action at that level that validates it. Now, the second core concept they talk about is break and retest. This one often hints at a potential change in the short-term trend on that time frame.
Okay, break and retest. Sounds important. Let's do the breakdown and retest first.
Okay, so let's say price is trading happily above the VWAP, suggesting that bullish bias. Then you get a candle, maybe a strong red one, that breaks decisively through the VWAP line downwards. But crucially, the signal isn't just the break itself.
Right, you mentioned the retest.
Yeah, the source really emphasizes waiting for the retest. Often, after breaking down through a level like VWAP, the price will pull back up to touch the VWAP line again from below. That's the retest. If, after touching it, the price then moves back down away from VWAP again, well, that provides confirmation.
Confirmation of what?
Confirmation that the level that was support, when price was above, might now be acting as resistance. It confirms a potential shift from a bullish trend to a bearish one on this time frame.
I see. So the retest is like the market validating that break, making it less likely it was just a fake-out move.
That's the idea, yeah. And the breakup and retest is just the opposite scenario. Price is trading below VWAP, bearish bias, then it breaks clearly through the VWAP line upwards. But again, you wait. It often comes back down to touch the VWAP line from above, that's the retest, and then if it moves back up again.
That confirms a potential shift from bearish to bullish.
Exactly. The level that was resistance might now be acting as support.
Okay, so these patterns, the bounce, the reject, and these break-retest scenarios, they all hinge on VWAP being the critical benchmark level where the action happens.
Yes, absolutely. And this leads directly to the core rule for actually taking trades using this strategy, according to the source anyway.
Which is?
All potential trade entries should be planned around the VWAP line itself.
Around VWAP, meaning like close to it, not when the price is miles away.
Yeah, the source is pretty adamant about that. They say taking trades when the price is far away from the VWAP line significantly lowers the probability of success for this specific strategy. VWAP represents that session's volume-weighted average. It's kind of where the market finds balance on average.
Right.
So these patterns, the bounce, reject, break, retest, occurring right at VWAP, are seen as meaningful interactions at this key level. They validate the signal because they're happening at that important benchmark.
It really narrows down the focus, doesn't it? Gives you a specific zone to watch for setups. The source apparently used some examples from an Ethereum 5-minute chart to illustrate this. Can we walk through one or two?
Yeah, absolutely. So one example they showed was a classic breakup and retest. Price was initially below VWAP, suggesting, a bearish lean on that 5-minute chart.
Okay.
Then a strong green candle just broke decisively above the VWAP line. Price popped up a bit, but then it pulled back down to retest the VWAP line from above.
So it touched VWAP again.
Exactly. And crucially, the next candle after that touch confirmed the move upwards, away from VWAP.
Okay, so based on this strategy, where would the entry be?
The entry could be planned on that confirmation candle, the one after the retest held. That whole sequence signals a potential shift, maybe from bearish to bullish, just on that 5-minute time frame.
Right, the retest gave the confirmation needed.
Correct. Then there was another example showing a breakdown in retest. So price was above VWAP, looking kind of bullish. Then a big red candle just sliced down through VWAP.
And the source mentioned a couple of ways to potentially play that, like a risky entry.
Yeah, they acknowledged that some, maybe more aggressive traders might jump in short right on that initial breakdown candle, placing a stop loss just above the high of that candle's wick.
But maybe not for beginners.
Probably not ideal, yeah.
Mm-hmm.
The source suggested a more, let's say, risk-averse approach is to wait for the retest. So price breaks down, maybe drifts a bit lower, then it often retraces back up to test that VWAP line for underneath. If a subsequent candle then confirms downward movement after that retest fails to break back above VWAP, that's where a potentially safer entry could be planned for a short trade.
And in that case, with the retest confirming resistance, the source suggested the stop loss could potentially go right at the VWAP line itself.
Yeah, often. Waiting for that retest confirmation can sometimes allow for a tighter stop loss, placed right at the level that just demonstrated its importance in this case, as resistance. This whole pattern signals that potential shift from bullish to bearish.
Gotcha. Did they show examples of the reject scenario too?
They did. In one instance, price was below VWAP, it moved up to touch it, but the candle that formed right at VWAP was, well, it was small. Indecisive looking.
Small candle.
Yeah.
What does it usually suggest in this context?
Well, a small candle, especially after a move into a key level like VWAP, often signals a bit of indecision, or maybe just a lack of strong conviction from either buyers or sellers right at that moment. Coming up from below, it suggests the buyers didn't really have the power to push price convincingly above VWAP.
So how do you know it's actually a rejection then, and not just a pause?
Good question. The source showed what happened next. A second red candle formed immediately after that small, indecisive one. That follow-through selling pressure, that second red candle, confirms that sellers are taking back control and validates the rejection at VWAP.
Ah, okay.
So a short trade entry could then be planned on that second red candle, expecting that the existing bearish trend might continue.
So it's like a probe towards VWAP from the wrong side. It's all showing weakness, and then a confirmation candle pushes it back in the original direction.
That's the essence of it, yeah. And they also highlighted what they called a strong reject scenario. Similar setup. Price below VWAP moves up to touch it. But this time, the candle that forms right at VWAP has a very long upper wick, and it closes near or even below VWAP.
Oh, those long wicks. They definitely tell a story, don't they? Like, price tried hard to go up but got smacked back down.
They really do. That long upper wick is visually quite important here. It clearly shows buyers attempted to push the price up, maybe quite aggressively, perhaps aiming for a break above VWAP. But sellers stepped in even more forcefully and pushed the price all the way back down before the candle closed. That creates the long wick. It's a strong sign of sellers dominating at that level.
That sounds like a pretty clear signal. What did the source suggest for entry there?
They suggested you could potentially plan an entry right on that long wicked candle itself for a short trade, anticipating continuation down. The stop loss could then be placed maybe just above the high of that wick.
Because the wick high represents the point where sellers overwhelm the buyers.
Exactly. A strong rejection candle like that is often seen as a higher probability signal that the existing bearish trend is likely to resume from that point.
Okay, so just to quickly recap the stop loss ideas from the source then. If you take an earlier entry, maybe on the initial break candle itself, the stop is generally placed near the previous candle's high or low.
Right, a bit more room usually.
But for the, let's say, safer entry that waits for the retest confirmation candle, the stop loss can often be placed much tighter, sometimes right at the VWAP level itself.
Yeah, that retest confirmation is key. It allows for potentially a more precise stop loss, often tighter, placed right at the level that just proved itself either as support or resistance.
This strategy seems to offer a pretty clear framework. But, as the source rightly points out, no trading strategy works all the time.
Absolutely not. Nothing is 100%.
So knowing when not to use this strategy is probably just as vital. Did they cover that?
Yes, definitely. They pointed out two main scenarios where you should probably just sit on your hands with this particular approach. The first one is when the VWAP line itself is very flat.
Flat VWAP. Like just going sideways, what does that indicate?
Yeah, basically horizontal. A flat VWAP line usually occurs in, well, sideways or range-bound markets. There's just low volatility, not much directional momentum or conviction. And in those kinds of conditions, the signals you might think you're seeing, like little bounces or rejects or breaks, are much more likely to be false signals. Just noise or whipsaws. There simply isn't enough directional oomph for a decent short-term trade to develop easily.
So you need some angle to the VWAP line, some slope.
Ideally, yes. The source suggests looking for a curvish or sloping VWAP line, either up or down, that indicates there's some underlying momentum, some trendiness in the market on that time frame, which the strategy relies on. Flat means choppy, low momentum, probably best to avoid.
Okay, avoid flat VWAP. What was the second scenario to steer clear of?
The second one is when the price action has been trading entirely on one side of the VWAP line for, a significant period of time within that time frame you're watching.
Meaning, like, say, the price has been consistently way below VWAP for hours, and the VWAP line itself is sloping down sharply, showing a really strong, established downtrend.
Exactly that kind of picture. If you have a very strong, obvious existing trend like that, consistently above a rising VWAP for bullish, or consistently below a falling VWAP for bearish, and then you get a signal against that dominant trend.
Like a little bounce signal near VWAP in that strong downtrend example.
Precisely. The source suggests that taking a signal against such an overwhelming established bias is likely a low probability trade. It's probably just a minor pullback or a false signal against the main flow on that time frame. Best avoided.
So basically, don't try to fade a really strong, obvious trend using these signals. Don't try to catch that falling knife or bet on a tiny bounce when everything is screaming downwards.
Yeah, that's a good summary. This whole approach, by focusing just on VWAP and these fundamental price action patterns, the bounce, the reject, the break retest, validated right at that key level,
Yeah.
it's really designed to declutter your charts and sharpen your focus.
Right.
You're using VWAP not just as another line on the chart, but as the crucial benchmark, the stage, where these specific interactions gain significance and potentially signal opportunities.
So it's not about some magic new indicator, is it? It's about using a well-known one, VWAP, but in a very disciplined, focused way. Using it as the context for interpreting basic, core price action.
Mm-hmm.
And the promise is that this provides maybe a cleaner, less confusing framework for tackling short-term trading or scalping, compared to staring at 5 different oscillators and 3 moving averages, all giving conflicting signals.
It really tries to boil down the complexity to reading simple, hopefully repeatable interactions right at that key volume-weighted average price level.
Okay, so the core takeaway then, from this deep dive into our source material, really seems to be about the potential power of simplification in trading.
I think so, yeah.
By focusing your attention on VWAP as your main benchmark, and then looking for those specific classic price action patterns around it, the bounce, the reject, the break and retest, you might be able to filter out a lot of the noise and find clearer potential trade signals.
It's about paying close attention to what the price is actually doing when it interacts with a level that represents the average price weighted by market activity. A level that, theoretically, carries some significance.
Which kind of leads us to a final thought for you, the listener, to maybe ponder on. How might focusing deeply, really deeply, on just 1 or 2 core concepts or tools instead of trying to juggle and master a dozen things all at once, how might that change the way you approach learning any complex new skill or topic, not just trading?
Interesting question.
Is true effectiveness sometimes found not in constantly adding more complexity, but maybe in refining your focus, going deeper on less? Something to think about.